Hello and welcome to Investment Insight. Before we begin, make sure to subscribe and hit the like button. Now let's break down what's happening in the markets today in a clear and simple way.
Sounds good.
So, if you look at the headlines lately, they claim big tech is just writing these massive blank checks to nuclear startups, right? All to power the artificial intelligence revolution.
Right, yeah, that's the narrative you see everywhere.
Exactly. But if you look closer at the actual contracts, you'll find they aren't really buying power at all. They are essentially buying eject buttons.
That is a very accurate way to put it.
Yeah, so today is Sunday, May 3, 2026. And our mission for this deep dive is to really look under the hood of these massive big tech energy deals. We want to demystify these complex contracts that are, shaping the future of the grid and show you exactly where the real money is moving.
Which is so important right now, because to understand the actual market dynamics, we have to stop viewing these tech nuclear partnerships as traditional utility orders.
Right, like they're not just paying a monthly electric bill.
Exactly. I mean, when a company signs a standard power purchase agreement, they're simply buying a flow of electricity. But recent analysis reveals that these deals between tech giants and nuclear startups are fundamentally different.
How so?
Well, they are highly calculated risk-sharing experiments. They're designed to test unproven technology without, exposing the tech companies to infinite financial liability.
But the headlines certainly paint a different picture.
Hmm.
I mean, we see Meta, Google, Amazon partnering with nuclear startups like Kairos, X-Energy, Oklo, TerraPower.
Oh, yeah, the PR makes it sound like a done deal.
Right. The broader narrative assumes big tech is just walking into a dealership, pointing at a nuclear plant, paying the sticker price, and expecting electricity tomorrow.
Which is wild, because there are exactly 0 small modular reactors operating commercially in the United States today. 0.
Right. So wait, they aren't buying a finished product at all? Are they just buying an idea?
Basically, yes.
I mean, to put it in everyday terms for you listening, it operates much more like hiring a contractor to build a completely custom home from scratch on an empty lot.
That's a perfect analogy.
Yeah, because you would never hand a contractor all the cash up front on day one, right? You structure the payments in milestones.
Exactly.
Like you release funds when the foundation is poured, and then, maybe again when the roof is framed.
And we see that precise milestone structure in the recent analysis of Google's deal with Kairos Power.
Okay, let's break that one down.
So they are aiming to deploy a first batch of reactors by 2030, right? And scaling up to 500 megawatts by 2035.
That sounds like a lot of power.
It is, but the legal framework for this is called a Master Plant Development Agreement. Google is only committing capital if Kairos hits highly specific sequential targets.
So they have to actually prove they are making progress.
Exactly. They must successfully navigate the complex federal licensing process. They must hit physical construction timelines. And crucially, they must hit strict economic targets regarding the actual cost of the power generated.
Wow. So if the developer misses those milestones,
Google is insulated. They are not contractually obligated to keep funding a stalled project. They can just pull the plug.
they hit the eject button.
Precisely.
Now, Amazon took a really similar approach with their $500 million Series C1 investment in X-Energy, right?
Right.
Because that capital isn't purchasing a functioning reactor either. It is funding early-stage development, the regulatory licensing process, and this specialized fuel manufacturing facility called TrizoX.
Right. And Triso fuel is a perfect example of why this technology is still entirely in the developmental phase.
Can you explain that? Like, what actually is Trizo fuel?
Sure. So instead of traditional, long metal fuel rods that you picture in a legacy nuclear plant, Triso fuel encapsulates tiny uranium particles in layers of carbon and ceramics.
Almost like a jawbreaker candy.
Yes, exactly like a microscopic jawbreaker. And the physics behind it essentially make it structurally incapable of melting down.
Wait, really? Incapable of melting down.
Yeah, because the ceramic layers can withstand temperatures far higher than the reactor itself can even generate.
That sounds amazing. So what's the catch?
The catch is manufacturing. Making those microscopic layered particles at a commercial scale is a massive, totally unproven hurdle.
Ah, I see. So Amazon's investment is helping them figure out how to actually make the fuel.
Right. Amazon secures an option to purchase over 5 gigawatts of power by 2039 through this investment, but an option is the key word there.
Meaning they don't have to buy it.
Exactly. They are basically securing a place at the front of the line for the 2030s. By funding that Trezo X facility, Amazon is helping build the infrastructure required for the reactor to even function.
But if the manufacturing scaling fails?
Or if the costs just spiral out of control over the next decade, Amazon has structured the deal so they can walk away.
Wow.
They are giving these startups enough capital to prove their concepts, but they are absolutely maintaining strict off-ramps to protect their own balance sheets.
This extreme caution makes total sense, though, when you look at the graveyard of past SMR projects.
Oh, absolutely.
I mean, these tech giants have staggering amounts of capital, but they are terrified of repeating the NuScale UMPS disaster.
That was a huge wake-up call for the industry.
Yeah, for anyone tracking the energy markets, the 2023 collapse of that project was huge because NuScale was like a pioneer in this space, right?
You were the golden child for a while.
Exactly. And they had a 462 megawatt project planned with a group of local municipalities and public power agencies. But the data shows it didn't fail because the reactor design was physically flawed.
No, the physics were sound.
It failed because the economics broke down completely.
Completely. The projected costs to manufacture and build that specific facility just skyrocketed.
Because of what? Inflation.
Inflation, rising interest rates, and really severe supply chain bottlenecks. And the buyers of that future power, the small tier governments and local utility agencies, they simply could not absorb the massive cost revisions.
I mean, who could?
Right. When the price tag ballooned beyond the initial estimates, the local municipalities got scared and pulled out of the agreement. And without guaranteed buyers for the electricity, the entire project just died on the vine.
It's remarkably similar to, like, a group of friends agreeing to split the cost of a summer vacation rental.
Oh, I like that.
Yeah, everyone is on board when the price is reasonable. But when the landlord suddenly triples the rate due to unforeseen maintenance costs, people start dropping out of the group chat.
Yeah, and eventually there aren't enough people left to cover the lease, and the whole trip is canceled.
Exactly. That no-scale failure proved to the broader market that even brilliant workable technology will fail if the underlying financial model collapses.
And that municipal-level panic sent a definitive signal to the tech giants. It established the absolute necessity for strict budget caps.
But wait, let me push back on that for a second.
But-
Because there is this common assumption that AI data centers need power so desperately that they'll pay literally whatever it takes. I mean, they need 247 uninterrupted electricity to keep the internet and these AI models running, right?
It is true that they place immense value on what the industry calls clean, firm power.
Meaning reliable and green.
Yes. Electricity that generates zero carbon emissions and operates consistently regardless of weather conditions, unlike wind or solar. But that premium has a hard ceiling. They will not pay an infinite amount.
Okay, so where is that ceiling?
We can actually see exactly where it is by looking at Microsoft's agreement to restart the closed 3 Mile Island nuclear plant.
Right, that was a huge story recently.
It was. Analysts at Jefferies estimate that Microsoft might be paying somewhere in the range of $110 to $115 per megawatt hour for that reliable electricity.
Is that a lot?
It is a substantial, noticeable premium over standard wholesale electricity market rates. So Microsoft is clearly willing to open its wallet for reliability. But that figure also sets a benchmark for the rest of the industry.
Okay, so that's the ceiling.
Exactly. Any new small modular reactor project must prove it can produce power competitively within that established premium range. The financial sector refers to this as being bankable.
So if an SMR developer, completes their engineering phase, factors in supply chain costs, and determines their power will actually cost double that Microsoft benchmark.
Then the tech giants will utilize those contract eject buttons. SMRs might receive some financial leeway because they are clean and reliable, but they still have to operate within the bounds of economic reality.
That makes a lot of sense. So if SMRs face these rigorous financial tests and commercial rollout is realistically slated for the late 2030s at best, we have to look at how big tech is powering the artificial intelligence infrastructure right now.
Right, because data centers are breaking ground today, they need power today.
Exactly. And looking at recent analysis, SMR developers aren't just competing against other nuclear startups to build the best tiny reactor. They are engaged in a fierce competition with literally every other method of generating electricity.
The industry calls this the all-of-the-above strategy.
Okay, tell me more about that.
Well, developers are currently planning an astonishing 56 gigawatts of on-site power globally, specifically for data centers.
56 gigawatts. Just to put that in perspective for you listening,
Yeah.
that is roughly equivalent to the entire power grid capacity of a medium-sized country.
It's massive, and big tech's ultimate objective isn't to ensure the success of the SMR industry.
Yeah.
Their objective is simply to secure reliable electricity, period.
They just need to keep the lights on.
Right. They are utilizing a massive portfolio approach. They're mixing and matching every available generation technology to keep their servers operational today while they hedge for the future.
I was actually looking at recent data on Meta's energy portfolio, and it perfectly illustrates this strategy.
Oh, absolutely. Meta is the perfect example.
Yeah, because Meta holds a massive 6.6 gigawatt nuclear portfolio, which includes those milestone-based SMR bets with TerraPower and Oklo.
Right, the long-term bets.
But they aren't waiting until 2035 to power their servers. In January 2026, Meta aggressively secured power from Vistra's existing traditional nuclear fleet.
Meaning nuclear plants that are already built and running.
Exactly. And then in April 2026, they signed a highly experimental early access deal with a company called Overview Energy to procure space solar power.
Space solar power. Which is just wild to think about.
It sounds like sci-fi. It's technology that involves beaming captured solar energy from satellites down to receivers on Earth.
And when you combine Meta's space solar investment with their simultaneous actions in the fossil fuel market, the breadth of their strategy becomes really clear.
Right, they're doing fossil fuels too.
Oh, heavily.
Yeah.
At the exact same time they were funding space solar and next-generation nuclear, a traditional utility company named Entergy announced plans to construct 7 massive new natural gas plants in Louisiana.
7 new gas plants.
Yep, totaling over 5.2 gigawatts of power. And those gas plants are being built specifically to serve Meta's expanding data centers in that region. Furthermore, NextEra Energy is currently securing large-scale gas-fired power contracts tailored for data centers, backed by substantial Japanese financial support.
So it operates just like placing strategic bets at a racetrack.
That's a great way to think about it.
Right, like if you are a tech giant managing a massive pile of capital, you place a few chips on the exciting, high-upside long-shot horse that represents the small modular reactors.
Right.
You throw a chip on the highly experimental horse with massive odds. That's the space solar power.
Also true.
But you place your heavy, immediate capital on the reliable, proven workhorses that you know can run the track today. And right now, those workhorses are traditional natural gas plants and existing legacy nuclear facilities.
Yes, and this creates a critical reality check for the nuclear industry. SMRs do not have a guaranteed, preordained monopoly on the future of data center energy.
They really don't.
They are in a direct, high-stakes conflict with natural gas and the life extension of existing nuclear plants. SMRs have to beat those legacy workhorses on construction speed and overall price per megawatt hour.
And if they don't,
If they fail to compete on those two metrics, they will be left behind as interesting but economically unviable science experiments.
that is a brutal reality. So if big tech is merely running calculated tests on SMRs, and these reactor developers are facing massive financial risks and intense competition from natural gas, it really shifts how we should view the underlying market.
It absolutely does.
I mean, in financial analysis, we often hear the cliche about selling picks and shovels during a gold rush, right? Don't invest in the gold miners, invest in the guys selling the shovels.
Exactly. And looking at the actual supply chain data for advanced nuclear energy, a much more accurate comparison for today is the modern semiconductor industry.
Oh, interesting. How so?
Well, investors often fixate on the household name companies designing the computer chips. But the true foundational power is held by the obscure, highly specialized companies manufacturing the massive machines required to actually print those chips.
Right, the companies making the equipment hold all the leverage.
Yes. And in the small modular reactor sector, the primary bottleneck is not the theoretical physics or the reactor design.
Because we already know how to split the atom.
Exactly. The physics of advanced nuclear generation have been largely understood for decades. The actual critical bottleneck is the physical supply chain.
The actual parts.
Yes. According to manufacturing data from April 2026, SMR developers are engaged in fierce competition simply to secure production slots with global suppliers. We are talking about the heavy industrial companies that manufacture massive steam generators, specialized safety valves, and most importantly, the giant reactor pressure vessels.
Right. And for those who might not know, a reactor pressure vessel isn't something that can just be ordered from a standard industrial catalog.
Not at all.
It's essentially a giant steel thermos. It must be forged from a single massive ingot of specialized steel so that it has zero seams or welds, because welds could be weakened by intense pressure and constant radiation.
Right, safety is paramount.
And forging a single piece of steel that large requires specialized hydraulic presses capable of exerting tens of thousands of tons of force. There are only a very small handful of ultra-heavy forging facilities on Earth capable of executing that kind of manufacturing.
And the companies that control those rare manufacturing facilities hold incredible leverage in this emerging economy.
They hold all the cards.
They really do. Looking at the international context, specialized heavy manufacturing firms in places like South Korea are playing a highly calculated long game.
What are they doing?
Well, they are currently negotiating with SMR developers and may actually agree to take significantly lower profit margins on the manufacturing of the very first few reactor components.
Wait, why would they take a lower profit margin?
Because taking a temporary hit on profits makes strategic sense. The first physical build of any new reactor design is incredibly difficult. It serves as the ultimate proof of concept.
Okay, I see.
But once a South Korean supplier proves they can successfully forge these complex pressure vessels and deliver them on time and on budget, they establish themselves as the gold standard for the industry.
And the entire economic premise of a small modular reactor is that once the design is finalized, it is stamped out in a centralized factory setting over and over again.
Exactly. Mass production.
So if a supplier secures the contract to be the primary provider for that standardized assembly line, they effectively capture the entire hardware market for the 2030s.
Bingo. And the urgency of establishing this reliable supply chain extends far beyond heavy metal forging. It is currently recognized at the highest levels of government policy.
Right. Government intervention is huge here.
Under the current Trump administration, the United States government has intervened with serious capital to secure the chemical side of the supply chain.
The fuel.
The fuel. They recently allocated $2.7 billion across 3 different nuclear fuel developers with a very specific mandate: to revive the domestic supply chain for high-assay, low-enriched uranium, commonly known as HAO.
HALEU, right.
Yeah.
Now, let's explain why that matters. Because traditional legacy nuclear reactors generally use uranium fuel that is enriched to about 5%.
Right.
But small modular reactors are designed to be much smaller physically while still generating massive amounts of power.
Yeah.
And they are designed to run for much longer periods before needing to be refueled.
Sometimes decades.
Right. So to achieve that density and longevity, they require this HALEU fuel, which is enriched up to 20%.
And currently, the infrastructure to enrich and manufacture that specific grade of fuel is incredibly fragile and limited in the U.S.
So you could have the best reactor in the world.
You can finalize the most elegant SMR design in the world and secure a massive master plant development agreement from Google. But if you do not have a secure domestic supply of that specialized 20% enriched uranium to put inside the core,
Then what?
then the reactor is essentially a multi-billion-dollar paperweight.
Wow. A multi-billion-dollar paperweight.
Yeah. So the federal allocation of $2.7 billion is an explicit acknowledgement that without the unglamorous foundational supply chain, the fuel enrichment facilities, and the heavy forging presses, there is no advanced nuclear revolution.
It all comes back to the picks and shovels.
It really does.
Well, we have covered a massive amount of technical and economic ground today, looking deep into the structure of these energy markets.
It's a complex space, for sure.
It is. Let me just do a quick recap of the most vital takeaways from today's analysis for everyone listening. First, those big tech nuclear contracts dominating the news cycle are strict, milestone-based options designed to limit corporate liability. They are not guaranteed blank checks.
Right.
Second, the risk of total project failure is an ever-present reality due to inflation and supply chain costs, which was clearly demonstrated by the collapse of the no-scale project.
A very harsh lesson.
Absolutely. Third, SMRs do not operate in a vacuum. They are fiercely competing against natural gas, existing nuclear plants, and advanced solar for massive data center contracts. And finally, the ultimate economic leverage in this developing sector likely belongs to the specialized supply chain manufacturers, the companies forging the steel and enriching the fuel.
That is an excellent summary. And it fundamentally reframes how we should analyze corporate energy announcements going forward.
Completely.
And as we wrap up, I want to leave you with one final thought to ponder. It's a broader implication of everything we've explored today.
What's that?
We are currently watching the world's wealthiest technology companies essentially build their own massive private energy grids.
Yeah, they really are.
They are securing output from existing nuclear plants, funding the next generation of reactors, and triggering the construction of massive natural gas plants exclusively for their artificial intelligence data centers.
So as these tech giants become their own private utility ecosystems, what does that mean for the regular public power grid?
Exactly. Well, everyday consumers and local communities eventually benefit from this massive influx of private energy funding and innovation.
Or are we heading toward a fractured system, like a reality where we see a stark divide between ultra-powered, incredibly reliable private grids for tech hubs and a struggling, underfunded secondary grid for the rest of the country?
It is a profound structural question, and honestly, it will probably define the next decade of infrastructure.
That is a phenomenal question, and one we will definitely be watching closely as these massive energy investments begin to break ground. Don't forget to subscribe and hit that like button.